You walk into a bank and deposit $1,000. The bank says thank you, promises to keep it safe, and maybe pays you 1% interest per year. $10, that's your cut. And the bank takes your $1,000 and lends it to someone else at 7% interest. $70. Yeah, that's their cut. You did the saving, they did the lending. Made 7 times what you made from your money. And that's just the beginning. Because the way banks actually make money is so much stranger than you think. And once you see it, you can't unsee it. Let's start with the basic game. You deposit money. The bank holds it. But they don't just let it sit there. They lend it out to people buying homes, starting businesses, buying cars. This is called a spread. You get paid 1%, they charge 7%. The difference, 6%, is profit. Seems simple. Seems fair even. They're taking the risk, right? Except here's the part they don't advertise. When you deposit $1,000, the bank doesn't keep $1,000. They keep a fraction, maybe $100, maybe less the rest. They lend it out. $900 goes to someone else, but here's the magic trick. Your account still shows $1,000. You can withdraw at any time. As far as you're concerned, your money is there. And the person who borrowed $900, their account now shows $900. So your $1,000 just became $1,900 out of thin air. This is called fractional reserve banking, and it's completely legal. Let's go deeper. That person who borrowed $900, they spend it. Maybe they buy a car. The car dealer deposits that $900 into their bank. Now the bank has $900 in new deposits. They keep 10%. $90, they lend out $810. That borrower spends it. Someone else deposits it. The cycle continues. By the time it's done, your original $1,000 deposit has created $9,000 in the economy. This is called the money multiplier. One deposit, 9 times the money. The bank collects interest on all of it. Collect interest on $1,000. The spread isn't where the real money is anymore. Banks figured out something better. Fees. Overdraft fees. ATM fees. Monthly maintenance fees. Wire transfer fees. Insufficient funds fees. Account closure fees. In 2019, American banks collected $34 billion in overdraft fees alone. Think about that. You try to spend money you don't have. The bank could just decline the transaction. Costs them nothing. Instead, they approve it. Then charge you $35. You bought a $3 coffee. Now you owe $38. And if you can't pay, they charge you again. And again. It's the most profitable product banks have ever invented, because it targets the people who can least afford it. Then there are credit cards. The bank gives you a piece of plastic. You swipe it. You feel like you're spending your money. You're not. You're borrowing theirs. They charge you 20% interest. Sometimes more. Miss a payment? Late fee? $30? Go over your limit? Over limit fee? Another $30? But here's the really clever part. Every time you swipe that card, the merchant pays the bank a fee. Usually 2 to 3% of the purchase. You buy a $100 pair of shoes. The store pays the bank $3. You think you're the customer? You're not. You're the product. Merchant is the customer, and you're the reason they're paying. Let's talk about mortgages. You want to buy a house? Costs us $500,000? You don't have $500,000. The bank lends it to you. 30-year mortgage, 5% interest. You think you're borrowing $500,000? You're actually paying back $966,000. $466,000 in interest. Almost double. The bank just made more from your loan than the house originally cost. And if you can't pay, they take the house, sell it, keep the profit, and you still owe the difference. Heads they win, tails you lose. Now let's talk about the really sophisticated stuff. Banks don't just lend your deposits anymore. They trade. Stocks, bonds, derivatives, commodities, foreign currencies. They have entire divisions dedicated to making bets with your money. When they win, they keep the profits. When they lose, well, that's where it gets interesting. In 2008, banks made massive bets on mortgage-backed securities. Risky, complicated bets that nobody fully understood. The bets failed, so the banks started collapsing. So what happened? The government bailed them out with taxpayer money. Your money saved the banks, they gambled with your money, and the executives, they kept their bonuses. Here's another revenue stream you've never thought about: your data. Every transaction you make, the bank records. What you buy, where you shop, how much you spend, they analyze it, package it, sell it to advertisers, to insurance companies, to anyone who'll pay. You're not just a depositor, you're a data mine. And they're mining you for profit. Then there's something called the float. When you write a check or make a transfer, the money doesn't move instantly. It takes days. During those days, the bank has your money. They invest it. They earn interest on it. Multiply that by millions of transactions every day. It's billions in profit. From money that's in transit. It's money that isn't even theirs. Let's zoom out. Banks are the middlemen of everything. Every transaction, every loan, every investment. And middlemen always take a cut. You work, you earn, you save, you spend. At every single step, the bank is there, taking a percentage. It's the ultimate business model. Low risk, high reward. Backed by the government, because banks are too big to fail. Which means they're too big to lose. But here's the uncomfortable truth. Banks don't make money by being better at banking. They make money by being better at extracting fees from the vulnerable, extracting interest from the desperate, extracting data from the unaware. It's not about providing value anymore. It's about finding every possible way to monetize your financial life. So what's the alternative? Credit unions operate differently. They're nonprofits, owned by members, lower fees, better rates. But they don't advertise like banks. They don't have branches on every corner. Fintech companies are trying to disrupt. Lower fees, better apps, more transparency. But they're not banks. They don't have the same protections, the same infrastructure. And big banks are buying them or crushing them. Here's the thing about modern banking. It's not designed to help you build wealth. It's designed to extract wealth, slowly, quietly, with your permission. You signed the terms and conditions. You agreed to the fees. Nobody forced you, but nobody explained it either. So the next time you check your bank balance, remember this. That number on the screen, it's not really money. It's a promise. A promise that when you want your money, the bank will have it. But they don't have it. They lent it out 10 times over. The system works as long as everyone doesn't ask for their money at the same time. The moment they do, the magic breaks. And we've seen it break before. Banks make money the same way casinos do. The house always wins. Not because they're lucky, but because they designed the game. You're not playing against other customers. You're playing against the bank. They're playing with your chips. So here's the question to sit with. If banks make billions from your deposits, your fees, your data, your debt, who's really getting rich from your hard work? You or the people holding your money?